Hello, everyone. Welcome to another lecture on finance. This lecture basically deals with the portfolio theory. Uh, we all know that every person would like to invest the surplus money he has with him in order to get better returns. However, there are a number of choices available for any person to invest. So let us see all those choices which are available for a person. See, if you want to invest in gold, see the risk involved is very low, and the holding period will be generally from medium to long term. Return will also be medium, and liquidity will be high. You can sell the gold whenever you want to sell, provided you keep the gold as gold coins or gold ETFs. However, if you keep the gold as an ornament, it will not be a very good idea. The next is the government bonds. The bonds, given by government or treasury bills given by the Reserve Bank of India or central banks. Now, here the risk of government bonds or treasury bonds are very low. Holding period will be actually various types of holding period will be there, from 1 year to 5 year to 30 years holding period. So we can say short to medium to long. Here the return is from low to medium. You may get a return depending upon the volatility in the market and the depending upon the yield. The yield will be low to medium. Liquidity will also be low because there will be some amount of holding period which will be there generally for treasury bonds. Next comes fixed deposit. The fixed deposit has low risk. Holding period you can from short to medium to long term will be there. Return is also low. Generally you may get a return of about 5 to 7, max 8%. Whereas corporate fixed deposits may fetch you more, but they are not very secure. Liquidity will be high, provided you have to pay some pre-closures amount or penalties. Otherwise, you can close the fixed deposit whenever you want. Next comes mutual fund. The risk will be medium because mutual fund generally deals with bonds and also stocks, and shares. The holding period will be medium to long term. A minimum holding period for a mutual fund to generate good returns will be around minimum 5 years, and it can go up to 10 years. The return will be medium, and the liquidity is also medium because there will be some holding period, minimum holding period for mutual funds also. So next comes stocks. See, stocks has very high risk. Holding period will be medium to long term. Return will be high, and liquidity will also be high. You can liquidate your stocks. Liquidate means selling. You can sell the stocks whenever you want. And finally, the real estate, where the risk will be low. Holding period should be very long. Return will be high, depending upon where you are holding the real estate. And liquidity will be low. You cannot sell the real estate whenever you want. Other than that, there are other investment opportunity like alternate investment funds and holding diamonds and others, which I am not going to discuss because it is not in the purview for the retail investor. So with these options available to an investor would always like generally to have a combination of all these investment opportunities, various types of investment, so that he will get maximum returns. So with this point in mind, the portfolio theory generally gives a mathematical solution. What can be the optimum portfolio a person can have depending upon his risk appetite. Risk appetite means how much a person can take risk with his money. So based on that, we can optimize a portfolio and give a particular portfolio to a investor oblique a retail person. So now portfolio theory was generally, concept was coined by Harry Markowitz in 1950, and he quantified what is the risk a person should take or he is capable of taking, and depending on that, to develop a methodology or a mathematical methodology to design an optimal portfolio for a investor. So diversification is basically a process that will influence the risk. It means you can reduce the risk in a portfolio by diversification. What is diversification? You can, by investing in a combination of various types of investment opportunities available here, you can generally create a portfolio which will reduce the risk and also increases the returns. So that is why it is called as diversification. So if we want to diversify and quantify diversification and how it influences the risk, we have to consider various states of an economy. Whether the economy is in high growth phase, medium growth phase, low growth phase, or no growth phase. So in order to understand the concept of the portfolio theory, we shall just take a small example, and then further we will build upon various concepts of the portfolio theory, which are very important to derive the mathematical equation. So let us assume that we have three stocks A, B, and C. We know that the return of any three stocks, for example, Reliance is a stock, Bajaj Auto is a stock, and we can take Hindustan Unilever as another stock. All these stocks behave differently in a particular state of the economy. Okay, some are growth stocks, some are defensive stocks. Like pharma stocks are defensive stock; they perform well when the economy is not doing well. Whereas growth stocks like auto stocks and banking stocks do well when the economy is booming. So some stocks perform generally well in most of the situations, like FMCG stocks, where it is a consumption stock. Whether the economy is in a good state or bad state, there are certain items which you have to consume on a daily basis, and hence FMCG stocks like ITC, Hindustan Unilever, Marico, they are all stocks which do generally well in most of the states of the economy, but at the same time their returns will not be very high. So let us see this concept. Now, every decision which we take in your life has a little bit of risk involved in it. We can only reduce the risk, but we cannot completely eliminate the risk. We know that any financial asset, whether it is a fixed deposit or bonds or shares, they generate cash flows. So, riskiness of the financial asset is generally measured with the help of the cash flow it generates. So, if an asset generates more cash flow, it will tend to generally have a higher risk involved. Now, we shall understand the concept of what is historical return and what is historical risk. Now, historical return is nothing but, historical return is always calculated for a particular period. It can be for 1 year, 5 year, 1 quarter, like that. So, historical return is given by the formula cash flow received during the period. The period can be 1 quarter, the period can be half year, the period can be 1 year, the period can be 10 years. So we should not worry. That's why this word period is given. We have not given any specific mathematical figure like 1 year, 2 year and all has not been given. It's a period. Plus the price change over that period divided by the price at the beginning, that will give you the historical return. Price change is nothing but price at the start of the period minus the price at the end of the period. Let us understand with the help of a small formula. If we consider R as the return and C as the cash flow, PE as the price at the end, and PB as the price at the beginning, divided by PB at the beginning. Suppose if the cash flow received in 1 year is 100 and the price at the end of December, if we consider from January to December, if the end of the December is 200 rupees and when in January the price was 180 rupees, then the return generated R is 100 plus 200 minus 180 divided by 180, which is generally 120 divided by 180, which is 0.667%. Okay, this is the return generated by, this is the historical return. So this is how we calculate the historical return. Now, what is average? And see, these are all the nomenclature we should understand before going into the mathematical aspects of the portfolio theory. Average annual return is nothing but the arithmetic mean of the return each year or each period. We can say each year, each quarter, each 10-year, whatever period you want to take. So R bar is nothing but the arithmetic mean. The bar, wherever it comes, it is arithmetic mean. So this is the mean. Bar means mean. Okay. R bar is sigma. That is, this is sigma gives summation. Summation from I to n. N can be 12 months. N can be 6 months. N can be 3 months. So I is, it is a variable. I is equal to 1. I can change value from 1, 2, 3, 4 up to n. Okay. Of return for each month. That is sigma Ri. Ri is the return for each period. If you take I as 1, that is R1 plus I as 2, R2 plus I as 3, R3. If n is equal to 3, we finish at R3. So R1 plus R2 plus R3 divided by n is nothing but this. This is should be small n. It has given as large n. This n will be 3. So R1 plus R2 plus R3 divided by 3 if we consider it as n is equal to 3. Okay, that is arithmetic mean. N is equal to number of periods and R bar is the arithmetic mean. Okay, now let us understand what is geometric mean. See, when all the values of the returns are positive, then arithmetic mean performs well. However, during a period, if some of the values or the returns are negative, in such cases, it is better to take cumulative values, compounded annual growth rate of return rather than arithmetic mean. So how do you calculate compounded annual growth rate? Compounded annual growth rate is calculated using the concept of geometric mean. So geometric mean is nothing but it is 1 plus R1 plus 1 plus R2 plus 1 plus R3 up to 1 plus Rn. If n is 3, it will finish here only 1 plus R1 plus 1 plus R2 plus 1 plus R3 to the square root, to the root of 1 over n. Let us consider if R is 3 here. So it becomes 1 divided by 3. It is cube root. Okay. If R is considered as 5, it becomes, that is all these values to the power of 1 over 5 it becomes. Okay. Suppose if I say return in the first month is, first period is 10%, here it is 20% and it is 30%, it becomes 1.1, 1.2 and 1.3. So you add all these three and you take to the power of 1 over 3, 1 over 1 by 3, that is 0.333. So that is, and you subtract this value you get by minus 1. That is geometric mean. Now standard deviation. Deviation means variation. Standard deviation means variation from the mean. Now standard deviation give variability of the return from the mean. So how much does a return for a particular month or a particular period vary from the mean? So If you take sigma as the this is sigma, right? Sigma square is nothing but your variance. Okay, so variance is given by I is equal to summation of 1 I is equal I to n. That is, I can be 1 to n can be 3, 4, 5, whatever it is. Summation of deviation. What is the deviation? Suppose if we take for first 10 months, if you take the return as 5%, 6%, 7%, 8%, 9%, 10%, whatever it is, and you take the arithmetic mean of this is your arithmetic mean. Okay, and every month's return is subtracted from the mean. So that becomes the deviation from the mean. So the first month return deviated by the mean is Ri minus R bar, that is R1 minus R bar. Then R2 return of the second month minus R bar, the mean. And what are you doing? You are squaring it. Okay. So I is equal to 1 to n Ri minus R bar whole square divided by n minus 1. N minus 1 is for the population, and n is basically for a single sample, where R bar is the arithmetic mean and n is the number of periods. So sigma is your standard deviation. So sigma will be square root of the variance, that is sigma square. Any value of, that is the Ri, which is far away from the mean, that is the R bar, will have higher impact as the difference will be squared. So when you square the difference, it will have higher impact on the variability of the standard deviation. So let us understand the standard deviation concept with a small example. So let us take the nature of the economy as 1, 2, 3, 4. 4 states of economy. Okay. The state 1 may be high growth, state 2 may be medium growth, state 3 may be low growth, state 4 may be no growth. Let us consider one security I. This I you can consider as Reliance or anything. Okay. Now, if I consider security I, name it Reliance as of now, Reliance will give minus 10% when the economy is in high growth. Let us consider it for the time being. Security I give minus 10%. When it is in second state of economy, it gives 15%. When it is in third state, it gives 18%. And when it is in fourth state, it gives you 22%. What is the mean of all this? Arithmetic mean. You add all of them and divide by 4, because there are 4 values. So you add all of them and divide by 4. You get the mean of this security. This is the security. Okay. The mean is 11.25%. Now, what is the deviation from the mean? The return of the first state, that is the return of the security when the economy is in state 1, is minus 10%, minus this mean 11.25 is your deviation from the mean. Since it is a negative value, you are getting 2 here. Okay, that is minus 0.1 minus 0.1125 gives you minus 0.2125. Similarly, 0.15 minus 0.1125 gives you 0.0375, and so on. And what are you going to do? You are going to square. Why we are going to square? I will show you here. Okay. Here, if we go back, here, see, if you see here, that is Ri minus R bar whole square. See, that is what we are doing here. Okay. Ri state 1 minus mean, this is R bar. Okay, R bar is this, because we have taken the mean value of this. So deviation from mean is minus 2.125. And you square this value is squared here, you get all this value, you square each one, and the square of the deviation is 0.0625 for one security. Similarly, we have calculated for another security J. You can take the security J as FMCG like Hindustan Unilever or any other. So the standard deviation for security I will be square root of this 0.062675, which is 0.0834. So the deviation is 0.0834%. And similarly for another security J, it is square root of 0.028. That is, the standard deviation is 0.028. So next is, what is covariance? See, covariance is a concept which is a statistical tool which is used to analyze relation between two stocks. See, covariance, how do you find covariance? You find covariance by calculating the standard deviation of the two stocks. And then we analyze the movements, co-movements between the two stocks. Co-movements matlab how two stocks behave when they are in one particular state of economy. Suppose if they are in a high growth economy, if you are considering two stocks, Reliance and FMCG, how does Reliance behave and how does Hindustan Unilever behave when they are in the high growth economy? That analysis is done by calculating the standard deviation. What does covariance help? See, covariance will help us to measure the relation between the two stocks. However, covariance will not indicate the strength of the relation. So let us take with a very simple layman example. Suppose there are two persons, A and B. Okay. Now A and B is in the same college. Okay. Now, covariance is nothing but we try to find out what is the relation between A and B. Whether A and B, they don't know each other, or A and B, they know each other but just they say hi. So covariance means it helps to know whether they are they don't know each other, or they know each other, or they are just friends, or they are very good friends. So covariance means it will just try to help you to understand whether there is any relation between A and B, two persons. However, covariance will not tell you, even if you know there is a relation between A and B, how strong is the relationship between them. Are they such a good friend that they have common characteristics, or they have, even though they are friends, they may have different views about different things like sports, studies. Some may be good in studies, some may not good in studies. Some may be good in sport, other may not be good in sports. Something like that. So that strength it will not tell you. It will only tell you whether a relationship exists between two persons, A and B. That is covariance. Similarly, covariance will tell you whether there is any movements between two stocks. Yes, there is a movement. So what is the strength of the movement? It will not tell you. So how do we calculate covariance? Let us understand. Suppose if we consider RJT is equal to return of security J at period time T. The period can be 1, 2, 3, 4, 5. Security J is J. You can take J as a Reliance. Now, RJ bar is the expected return of the security J. What is expected return of security J? It is nothing but your arithmetic mean. And RMT is the return of the market index at time T. Okay. So now we are comparing the return of Reliance with the return of the market. Market return, like what is the return of Nifty 50 over a period of time. So that is known as market return. So here we are taking J as Reliance just to understand ourselves, and we are also taking M, that is RM, that is the market return at any point of time T. Now RM bar is nothing but your expected return of the market index, that is expected return of your Nifty 50 is the RM. So it is nothing but again the arithmetic mean of the market return over a period of time. So let us understand covariance. How do you calculate covariance? All you are going to do is you are going to sum the values of the deviations of the Reliance from its mean for a particular period. If the period is 5 years, so return of the Reliance for period 1 minus its mean, period 2 with its mean, we calculate the deviation and multiply these two deviation and divide it by the n minus 1. N is the number of periods. Suppose if the period is 10 years, it is n minus 1 means 10 minus 1, it becomes 9. So this is the formula for calculating the covariance. Okay, now let us understand this. So how do we calculate covariance? Now covariance is calculated by this formula. Alright. Now the period, now we have considered 10 periods. Let us assume it is 10 months or 10 quarters, whatever you can take, or 10 years. RJT, that is the return of stock J. J you can consider as reliance for period T. That is, if T becomes 1, its return of the reliance will be 10. Period 2, it will be 6. Period 3, it will be 13, and so on. Now what we have done, we have found out the mean, arithmetic mean. Sigma RJT by 10 is the arithmetic mean. So the arithmetic mean of return of RJ, that is if you consider it as reliance, is 12%. Similarly, this is RM, that is the market return. Market can be Nifty 50 market. Okay, Nifty 50 is the market index. So if we consider the return of the Nifty 50 as 12% in 1 year, 5% in 2 years, and so on, and the average value is 13 here, that is the return of the market, mean return of the market for the past 10 years will be 13. Now what are we going to do? We are finding the deviation from the mean, that is 10 minus 12 minus 2, 6 minus 12 minus 6, and so on for the RJ, that is the reliance stock. And similarly for the market, you are going to calculate the RMT minus RM bar, which is the deviation from the mean. And what you are going to do, you are going to multiply all these deviations from the mean. So RJT minus RJ, RMT minus, so this is the, you multiply the deviation of reliance from its mean value of 12%, mean return of 12%, and deviation of the market return from its mean of 13%. So you are multiplying these two, minus 2 into minus 1, 2, minus 6 into 8, 48. So that is the sum of all this will be 778. We have also calculated, we also want to calculate the variance. So the variance of the stock RJ, that is the reliance, will be RMT minus that is RJT minus RJ whole square to the power of square. And similarly for the market index, you are squaring RMT minus RM bar whole square. So this is the square of the deviation of market, and this is the square of the deviation of the RJ stock or the reliance we are considering for the time being. Now, so with this formula, so what has become? So sigma, the summation of RJT minus RMT minus RM is 778. And the variation is 1022 for the market index. And for RJ stock, the variation is 646. So now, how do you find the covariance between stock J and market index? The covariance is given by the formula which I have already explained, is this. So it is nothing but 778, which we calculated previously, divided by, there were 10 terms, so n minus 1, that is 10 minus 1 is 9, which is 86.4. So what is the variance of the market index, which we have already calculated? Sigma RMT minus RM, this should be bar, RM bar whole square, that is the deviation square divided by n minus 1, which is 1022 divided by 9, which is the 113.6. So the variation of the market index sigma m square is 113.6, and variation of stock J similarly is 71.77. Now let us analyze this. So what is the beta of a stock? It is very important. See, all these concepts which I am telling, standard deviation, covariance, beta, they all will be essential if you want to calculate the formula for an optimum portfolio. So if we understand these basic concepts, when you calculate and when you go to the advanced concept of security market line, capital market line and all, you will be using all these mathematical or statistical formulas. So if we consider RM as the market risk and RR is risk of a risky portfolio and RC as the risk of a conservative portfolio, we consider that the sensitivity of the stock to market movement as beta. So beta is nothing. We will study further about beta in the coming slides. Beta is nothing but how sensitive a stock is to the market movement. If the market is moving higher, whether the stock will move higher or lower, or how strong the market will move. So beta can be considered in science term as the momentum. See, the market portfolio will always have a beta of 1. So if you consider the beta of a stock as 1.5, it means if the market portfolio increases by 10%, return of the market portfolio increase by 10%, then the stock price will increase by 15% because it is 1.5 times. So 10 into 1.5 means it becomes 15%. So that stock with a beta of 1.5 will give a return of 15%. Usually, as a ballpark, the beta of a stock lies between 0.3 and 2. Now, what is the return of a stock? The return of a stock is given by the formula return of J stock at any point period of time t is given by lambda J plus beta, which is the nothing but your beta, that is beta J, that is beta of that stock, into RMT, which is nothing but the market return at that particular point of time, plus there is an error term EJ. Okay. If you see this equation closely, any science student will understand, or any mathematics student will understand that this is the equation of a straight line. Y is equal to mx plus c. Mx is your beta j RMT, and c is, which is the intercept term, is your lambda j. Now RJT is the return of the security, lambda j is your intercept term, and beta j is the regression coefficient. And EJ will be a random error term.
The relationship between diversification and what is the risk involved. We can assess this with the help of a simple graph. See, this graph displays standard deviation on the x-axis, and we have return of a stock J, or you can consider a return of any portfolio also on axis Y. Now we have this line whose slope is less, this angle is very less. Now any stock or a portfolio having less slope will have low beta. Low beta means risk. They have low risk. High beta means high risk. How high beta means high risk? Because the variation will be more for any change in the market index. The change in the stock will be very high, that is price of the stock will be very high if the beta is very high. Similarly, if the beta is low, for any percentage change in the market index, the percentage change in the portfolio or the percentage change in the stock will be less. So if we consider this, let us assume standard deviation of sigma 1. Standard deviation means what? It is the risk. Deviation means always a risk. Deviation from the mean means mean risk. If the stock price deviates more from its mean value, it means you are having higher risk in investing in that particular stock or in a particular portfolio. Similarly, the deviation from the mean is high, then it will have a higher risk. If the deviation from the mean is low, it will have a lower risk. So let us understand that. See, Here we have a line that is a low beta line. We can consider it as a portfolio of stocks. Now, if the portfolio has a standard deviation sigma 1, okay. Now, for the same standard deviation, if you are selected a portfolio which are having lower risk, see this line no, has got portfolio of stocks, so most of the stocks will have less beta. So, at any point of time, if we consider the portfolio deviation is sigma 1, so the return which you are going to get is only R1, this much only return you will get. However, if you consider this line, red line, this red line have got portfolio of stocks which have got higher beta or higher risk. So, for this same standard deviation, that is from the same standard deviation from the mean, you are getting higher return for this same standard deviation if you are taking higher risk. Okay, so what we are trying to convey is, if you select stocks with higher beta, your return will also be more, and if you select stocks with lower beta, your return commensurately will also be low. So, for any particular standard deviation, if you are taking higher risk, the return will also be more. That is what this graph is trying to convey to you. So, you might ask a question, if I consider red line, why for this same standard deviation we are getting higher return? It is because the stocks which are there in this particular red portfolio has got higher beta or higher risk. That is why you are getting higher return. Similarly, the stock on this particular line, that is green line, will have lower beta, so your lower risk will be there. So, as the standard deviation keeps on increasing, stocks which are on red line will give you more return compared to the stocks which are on the green line. If you extend these two lines on the negative side, then you will understand that if a stock starts giving negative returns, that is returns which is negatively correlated, then the returns, the loss which you are going to accrue is much more on this red portfolio compared to the green portfolio. So, this you have to understand. Now, so how do we calculate beta? Let us understand how do we calculate this beta, that is the risk of a particular portfolio or of a particular stock. Beta J is, you can consider any stock or any portfolio. So, beta J is the beta of any portfolio or stock, which can be calculated using the formula covariance between Rj, that is return of J stock or J portfolio, and return of the market index, divided by the covariance, that is the variance of the market index. This we have already calculated in our previous example which we discussed, which is 0.76. So, beta of a stock is calculated, or beta of a portfolio J is calculated by taking the covariance of Rj, return of J, and the return of M. So, you take the covariance of return J and return M and divide by the variance of the market index. That is what we did in our previous example. So, the result which we got is 0.76. Now, how do we calculate alpha? We know, we discussed this equation, RJT is nothing but return of stock j at any particular point of time t is equal to lambda j. Lambda is the intercept term, lambda j plus beta, we have already calculated beta j, into return of the market at any particular period of time t. So, if we rearrange this term, so alpha j will be return of jt, it is jt here, do not get confused, return rjt minus beta j and return of rm at any particular point of time t. So, we get lambda j as per our previous example, r bar j is nothing, this is r bar jt and r bar mt. So, lambda j is equal to r bar jt minus beta j into r bar mt, which is nothing but 12 minus 0.76 star. 0.76 is the beta which we have calculated here, into the mean of the market return is RM, it is into 13, which will give you 2.12% as the alpha of the stock J or portfolio J. Now, let us understand the concept of coefficient of correlation. See, coefficient of correlation and covariance, both of these mathematical variables or mathematical values reflect the degree of co-movement between two variables or two stocks in a portfolio. So, I will repeat, coefficient of correlation value and covariance value both reflect the co-movements between the mutual movements between two stocks or three stocks or four stocks in a portfolio. Now, the coefficient of correlation between a stock Rj and the market index is given by rho. This is this symbol, we call it as rho of I, at that is rho, coefficient, rho is coefficient of correlation. Coefficient of correlation between stock I and the market index, or stock J or the market index, you can take whichever way you want, which is equal to covariance between the return of stock I and the return of the market index divided by the standard deviation of stock I and the standard deviation of the market index, which is nothing but covariance between the return of stock I and the return of the market index can be written as sigma ij, standard deviation ij, divided by the sigma of index and sigma of market index and sigma of the stock I. That is nothing but 86.4 divided by square root of 113 because 113.6 was the variance of the stock I, into square root of 71.7, which is nothing but the variance of the market index. So, standard deviation between becomes square root of the variance is the standard deviation. So, you get the correlation between return of stock I and the return of market index as 0.96, where R rho Im is the correlation coefficient between stock I and M, and sigma Im is the covariance between, that is, stock I and stock J or stock M, that is the market is not J, it is covariance between stock I and market index M, and sigma I is standard deviation of the return on stock I, and sigma M is the standard deviation of the return on market index. Let me clear once again, sigma Im is the covariance between stock I and M market index, it is not J, it is wrongly typed here, it is M, it is not J. The value of coefficient of correlation always lies between -1 and +1. -1 represents perfect negative correlation and +1 represents perfect positive correlation. 0 represents no correlation between the two stocks. Now let us understand what are the various factors which affect beta. Beta means, again I repeat, risk of a particular stock or a particular portfolio. The first concept, if we take a particular stock or a particular portfolio, the financial leverage of a particular stock will affect the beta. See, you have to understand that certain industries or certain sectors are capital intensive sectors. So some companies raise debt or they take loan to increase the production, and hence the capital expenditure will increase. See, a company will raise debt or company will raise money in anticipation of any increased sales, and once the sales increases, the revenue will also simultaneously increase. The EBITDA of a company will also be high when you have taken loan, invested on capital expenditure, and you have increased the production, hence the sales has increased, so you will have more profit. So any company with high debt to equity ratio will have very high financial leverage. So you should know what is debt to equity ratio. That is the total loan raised by a company divided by the total shares outstanding of a particular company is the debt to equity ratio. If you want to know more about debt to equity ratio, I have put a link in the description. Please go there and check out. I have made extensive videos on debt to equity ratio and various financial ratios you can analyze. So wherever debt to equity ratio is high, the financial leverage will be high, and hence the beta of the stock will also be high. Since the company have raised lot of money and has increased production, any variation in sales, that is increase or decrease in the sales, will have direct impact on the beta and hence direct impact on the risk. Now let us have another concept called operational leverage. So this is another factor which affects the beta. Operating leverage is a little bit tricky concept. Let's understand this. See, operating leverage basically depends upon business cycle, like whether a company is new, that is whether it is an induction stage, or a company is in a growth phase, or the company has already matured and it is stable now, or a company is in such a sector where the sector is actually shrinking or contracting. If you want to know more about this, I have done a company analysis and a separate video. The link is there in the description. Please go and see there. I will not be able to explain this induction, growth, maturity and contraction phase of a company here because this video will become too long. Now, operating cost means the cost that is required to run a company to produce products. So operating costs have two sub costs associated with it. One is the fixed cost and another is the variable cost. What are the fixed cost? Any cost involved in real estate, equipment, electricity, wages, they all come under fixed cost, because this cost once established, you have taken a real estate, you have installed machinery, some amount of labor force you have already employed, you have to pay them salary whether the sales will be high or low, the machine will remain whether the sales be high or low. So these are fixed cost, you have to pay for this cost. However, operating costs are those costs which vary depending upon the production. Like suppose the electricity cost the cost of the raw material. These are the examples of variable cost. So the variable cost increase and decrease, but the fixed cost will remain. So any company which is having higher proportion of fixed cost and less variable cost will have high operating leverage. High operating leverage means if there is any decrease in sales, the fixed cost will remain the same, but the variable cost will go down. As a result, the cost, the profit percentage which the company is going to get when it sell will start shrinking drastically, because the company has to cater for that fixed cost which cannot be changed. So, any company having higher operating leverage will have higher beta, because as increase in sales will increase the contribution margin, and any decrease in sales will accordingly have a direct impact on the profitability of the company. So, operating leverage amplifies the cyclicality of revenue, as a result of which we have an increased beta. Okay, now let us take an example. Let us consider 4 states of economy, and we will give equal probability for the occurrence of this state of economy. You can take state 1 as a high growth, state 2 as a medium growth, state 3 as a low growth, and state 4 as a zero growth. See, we have to assign equal probability of occurrence of these 4 states only because we don't know, there are various factors, macroeconomic factors, politics, world markets, various leaders involved, various entities involved in the world will change the structure of the market drastically. So we really don't know when there is going to be high growth, when there is going to be medium growth, or when there is going to be low growth. So we are giving equal opportunity for all these. So equal opportunity means equal probability. Let us consider 3 stocks, stock A, stock B, and stock C. So when in state of economy, return of stock A will be 15, B will be 10, C will be 35, and similarly for other stocks. The return of the portfolio of all these 3 stocks when you are in state of economy 1 will be just addition of these 3, that is 15 plus 10 plus 35 becomes 60. Similarly, you can calculate for the others. Now, whenever a probability is involved, you are not going to calculate the mean. You don't call it mean, actually you are going to call it as expected return. That is, the mean of the return of the stock A in 4 states of economy will be called as expected return. So expected return is nothing but the mean of all the returns of stock A in various states of the economy. But here one important concept comes, that is, you have to multiply, because we don't know which state of economy is going to happen. We are giving equal opportunity or equal probability. So you multiply this probability with each stock return, and then when you add, you will get the expected return. So it is the weighted average. Weighted average, why we are saying? You are giving weightage to the each state of economy. So each state of economy will have different types of return, and when you multiply the probability with the return, it becomes the weighted average return. So it is the weighted average return of all the possible returns multiplied by their respective probabilities. This is what I have tried to explain. So if I say RI, return of from stock under state I of the economy, matlab state I can be between 1 to 4 here. So return from stock under state I of economy, and n is the number of possible states of the economy. Here the 4 states are there. So the expected return from this stock is nothing but probability of state I of the economy. So expected return is nothing but you summate all the returns from I to n of any particular stock Ri, that is the return of the stock, into its probability. So this is known as the expected return. Now what is the variance of a stock? Variance of a portfolio is the sum of the squares of the deviations. It is the squares of the deviation of actual return from the expected return. We have calculated expected return here, and you are taking the deviation of the returns from the expected return multiplied by individual weighted probabilities of the economy. So sigma square, here it is sigma, it is given. Why sigma it is given? It becomes standard deviation here. Standard deviation is nothing but square root of the summation of the deviation. Deviation is what? Ri minus expected return R whole square into the probability of occurrence, that is given no weighted probability. Weighted probability into deviation. This is the deviation. Deviation of return of any particular stock in state of economy. So Ri minus expected return of a particular stock into whole square, that because we are saying sum of the squares, that is why we are squaring. And sum kahan aata hai? This sum will come here. So sum of the squares, this is the squares of the deviation, this is the deviation Ri minus sigma Ri, that is deviation of any return from the expected return into the weighted probability Pi will give you variance. When you take the square root of the variance, you get standard deviation. So we have understood what is expected return, and we have understood what is variance and standard deviation of a particular stock. Okay. With this knowledge in hand, let us go ahead and calculate the expected return and standard deviation of the portfolio in the table which we just saw behind. You can go back and check that. So now expected return is what? I have already told. Probability of occurrence, this is stock A. Okay. Probability of occurrence into the return, that is the stock A is giving 15% return in state 1 of the economy. The state 1 of economy has a probability of occurrence of 0.25. So 0.25 into 0.15 plus 0.25 into minus 0.10%, because stock A is giving negative return when it is in the state 2 of the economy, plus 0.25 into 0.1, that is stock A is giving 10% return in when it is in state 3 of an economy, and the probability of occurrence of state 3 is again 0.25 minus 0.25 into minus, that is plus, sorry, it is not minus, plus 0.25 into minus 0.05. So if you calculate this, you will get 2.5% as the expected return of stock A. Now we have to calculate the deviation of stock A from this mean. This is the mean. Expected return is nothing but your mean. This is the formula which we are trying to follow. So when we if we want to calculate this Pi into Ri minus sigma Ri whole square, Pi here is 0.25 into Ri is means we are taking the first state of economy R1. So in the first state of economy, stock A has a return of 0.15 minus what is the expected return? Here it is 2.5% becomes 0.025 into whole square. Similarly 0.25 into negative return minus 0.1 minus 0.025, that is the deviation, that is return minus expected return whole square, and similarly for others. So the variance here which comes is 8.8%. Deviation comes as 8.8%. So stock A has an expected return of 2.5 and a standard deviation of 8.8%. Similarly, I have calculated for stock B, that is expected return of stock B and standard deviation of stock B. Similarly for stock C. And now expected return and standard deviation of the portfolio is the same. The probability of occurrence is the same, 0.25, and at the rightmost column we have 0.6 as the total return of the portfolio, and 0.15 as the total return of the portfolio in when the state of economy is 2, and when the state of economy is 3 it is 0.45, and when the state of economy is 4 it is 0.025. Accordingly, the expected return is 31.25 and standard deviation is 22.71%. So, what are we going to analyze taking these values? Let us analyze. See, as we can see, the individual stock give lesser return compared to the portfolio. See, what is the portfolio return? Expected return of the portfolio is 31.25. Alright. What are the others giving? One is giving 13.75, and you can go back and see what others are giving. It is definitely less than the expected return of 31.25% given by the portfolio. Similarly, the deviation, even though the deviation of the portfolio is higher, 22.7%, but deviation means you reduce 22.1% from 31% and add 22.17% to the 31%. So, that is going to be the range of the values of the so even if we take the lower range of 31.25, because the deviation will be 22%, the lower range is 24% for the portfolio, which is still higher than the returns given by the other portfolio. Hence, we can conclude that a portfolio risk to return profile is better than individual stock. It means diversification always helps to some extent in reducing the risk and increasing the return. Reducing the risk means deviation will be less, increasing the return means expected return will be high. So, we can say that if the individual stock return is not perfectly positively correlated, then we can reduce the portfolio risk. So, what do you mean by perfectly not correlated, perfectly positively correlated? I will tell you. See, it is like this. If one stock in a state of economy, one stock is increased by 5% in state A, state 1 of the economy, and another stock also increase by 10%. And in the second state of economy, the second stock decreases by 5%, and another the stock B also returned by 5%. Then there is no diversification, there will be no counterbalance. Counterbalance can only happen if the stocks move in different direction in different states of the economy, because that will balance out the returns and you will get a better return to risk. And we have to understand that reduction in risk due to diversification happens only for around 20 security, as 20 securities means for 20 stocks, as mathematically mathematical simulation which has been conducted. So, beyond that 20 stocks in a portfolio, the diversification risk that is the risk will not reduce even if you increase the diversification. So, you need not do over diversification. It means you need not have 100 stocks in your portfolio to reduce the risk. Even if you have 15 to 20 good stocks in your portfolio, you can still reduce the risk almost by 99%, depending upon the type of indifference curve you are on, or the different types of stocks which you have chosen, and what are the betas of those particular stock. Now, now we will go a little bit ahead and dig deeper into the expected return of portfolio calculation. As I have already explained, it is the weighted average return of all individual stocks in a portfolio. Now, in a portfolio,
we know that we have something called as a weightage of stock. So if I consider omega as the weightage of stock I, what is weightage? You must understand. Weightage is nothing but the proportion or percentage of stock in a portfolio. The total weightage in a portfolio is always 1. So if the value of stocks, let us take an example of how to calculate weightage. If the value of stocks, 4 stocks, let us consider A, B, C and D in a portfolio is 100, 200, 150 and 250, then weightage of stock A is nothing but 100 divided by, you add all this, 250, 150, 200 and 100, you will get 700. So the weightage is 14% in the portfolio of stock A. So if you considered N as the number of stocks in a portfolio, expected return of the portfolio is nothing but expected return from the portfolio, and ERA is nothing but expected return from individual stock, then the expected return from the portfolio is nothing but I, that is the value I 1 to N. If you have 4 stocks in a portfolio, it becomes I is equal to 1 to 4. I will change value from 1 plus into 4. That then what it becomes, it is omega 1 into expected return of first stock. If I take I as 1, that is omega 1 into expected return of the stock 1 plus omega 2 into expected return of stock 2, omega 3 into expected return of stock 3 and omega 4 into expected return of stock 4. This is nothing but the expected return of the portfolio. So how do we calculate the risk of a portfolio? Now we have already analyzed that a risk of a portfolio depends upon how much the stocks in a portfolio are correlated with each other. Okay, if the individual stocks are totally uncorrelated with each other, then in that case we can use variance, because invariance is nothing but the deviation in the each stock itself. Variation is nothing but it is the deviation in each stock. So in that case, if all these stuff, let us consider a portfolio with 4 stocks. If all the 4 stocks are not correlated with each other, then we can purely consider the standard deviation of each stock itself will be the we can risk of the portfolio. But if the individual stocks are not totally uncorrelated, then we cannot use the standard variance, that is standard deviation, as the stock portfolio risk. That is standard see, if you have 4 stocks and all the 4 stocks are not correlated with each other, then all we do is standard deviation, the sum of the standard deviation of all 4 stocks will become the risk of a particular portfolio. However, if some stocks are related to each other, that is if their movement depending upon the movement of the market is related to each other, then we cannot use just the standard deviation of each particular stock as the portfolio risk. Then there is something called as, we need weighted risk of each particular stock and weighted co-movements, that is weighted co-movements between returns of the security. So weighted co-movements we know is returns of the securities mathematically analyzed by 2 mathematical concepts, that is one is covariance and another is coefficient of correlation. Covariance is an absolute measure, whereas coefficient of correlation is a relative measure. Now in covariance we have to understand, if there is a positive covariance between 2 stocks, it means the 2 stocks generally move in the same direction, but they not move in a perfect proportion. Suppose let us say in a state of economy 1, if stock A returns 10% and stock B return 7%, they are positively correlated because both of the stocks is moving positively in state 1 of the economy. Negative covariance means the return of stock will move in opposite direction. Let us consider again two stocks in state 1 of the economy. If one stock give 5% return in state 1 of the economy, but the stock B gives minus 2% return in state 1 of the economy, then they are negatively correlated, because one stock is giving a positive return, another stock is giving a negative return. Now, what is perfectly positive correlation and what is perfectly negative correlation? In perfectly positive correlation, what happens? If stock A in state 1 of the economy is moving 10%, stock B will also move same 10%. In perfect negative correlation, if stock A move 5% in state 1 of the economy, stock B will go move minus 5%. That is exact negative correlation. Now let us analyze how to calculate the covariance between two securities I and J. Suppose if I consider Pi as the probabilities associated with each state of the economy, Rij returns associated with stock I with stock J of the economy or state J of the economy, and if Rji returns associated with J stock with I state of the economy, then we can say give a deduction for the calculation of covariation between two securities I and J. So let us take this with an example. Suppose if we have two stocks X and Y. So how do we calculate the covariation between these two stocks? These two stocks, if I say X and Y, you can take it as I and J, anything will do. Suppose the covariance between the returns of stock X and Y, that is given by Rij, the probability of occurrence of state 1 into deviation of stock X in state 1 of the economy minus expected return of stock X into return of stock Y in state 1 of the economy minus expected return of the stock Y, plus P2 is the second state of the economy multiplied by return of stock X in state 2 of the economy minus expected return of the stock X into return of stock Y in state 2 of the economy minus expected return of Y. Similarly, you can keep adding for n variations. Okay. Now, expected return Rij is the expected return associated with each stock with each state of the economy. Now, let us understand with this simple illustration. 1, 2, 3, 4, 4 states of the economy. Probability of occurrence is given here. We have changed the probability. Instead of giving equal probability, we are giving different probability of occurrence. Now, let us understand return on security I as this and return on security J as this. So, expected return of I, as I have already explained, is 13.95. Expected return of J, already explained, it is 5.42. Now, this is the probability of occurrence, this is the return. Deviation is from the mean is deviation of 0.15 from 0.1395, that is 0.15 minus 0.1395 is this, 0.35 minus, that is here it is minus 0.10, which is the mean. Expected return of R is 13.95. So minus 0.10 minus 0.1395 will become minus 0.2395. This is the return of security I in state 2 of the economy, which is 0.15. 0.15 minus 0.1395 will become 0.1015. 0.18 minus 0.1395 become 0.045, and similarly for the others here. So this product of the deviation, this is the deviation of stock I and this is the deviation of stock J. So 0.235 into 0.042 is this, 0.105 into 0.068 is this. So if you add up all of them, you get 0.568. So Here we can conclude that the covariance between two securities is 0.568. Now let us understand coefficient of correlation. Coefficient of correlation and covariance both reflect the degree of co-movement between two variables, which I have already explained. So coefficient of correlation formula, I have already explained this in the previous, I will not explain again, and it has already been, I am just giving here this formula for you to just revise it, not for anything. We have to understand that the coefficient of correlation between two stocks always lies between -1 and +1. -1 means perfect negative, +1 means perfect positive, and 0 means no correlation. Let us see through a graph. See, this is positive correlation. It means, I have explained, the returns of the stock move in the same direction, in the positive direction. Perfect positive correlation means they move exactly in the same amount. Stock A and stock B move 10% up in state 1 of the economy is perfect positive correlation. Negative correlation means they move in different direction. As I have explained, if stock A moves 5% in state 1 of the economy, stock B may move -2%. But in perfect negative correlation, if stock A moves +5% in one state of the economy, the stock B will move -5% in the same state of the economy. And zero correlation is, you can see, there is no correlation. They can, it is all dispersed. So this is about the relationships between correlations. So this is a very important concept. What is positive correlation? What is perfect positive correlation? What is negative correlation and perfect negative correlation and zero correlation? After understanding this, we will go further with the concept of what is security market line, what is capital market line, what are indifferent curves, what is efficient market theory. That we will take in the next video.
Okay, let us now understand how to calculate a portfolio risk in case of two security case. Two security means if you are having two stocks in a portfolio, how do we calculate the portfolio risk involved? So the risk of a portfolio having two stocks or two security is given by the formula sigma p square. Sigma p means variance of the portfolio. Sigma p square means variance of the portfolio. Sigma p is nothing but your standard deviation of the portfolio. That will be equal to omega 1 square into sigma 1 square. Okay, let us analyze this. Omega 1 is nothing but the weightage of the stock 1 in the portfolio. So you are squaring the weightage into sigma 1 square. Sigma 1 is standard deviation of the stock 1. So you are squaring it. So when you are squaring the standard deviation, it becomes variance of stock 1 plus similarly weightage of stock 2 whole square into variance of stock 2. Sigma 2 square is variance of stock 2 plus 2 times the weightage of stock 1 into the weightage of stock 2 into multiplied by the standard deviation of stock 1, the standard deviation of the stock 2, that is sigma 1 sigma 2, and rho 1 2. What is rho 1 2? Rho 1 2 is you can call it as covariance between the stock 1 and stock 2 or coefficient of correlation between stock 1 or stock 2. So with that we can have actually a matrix. This is called as a matrix. If we put in the matrix square of weightage of stock 1 into the variance of stock 1, and here in the fourth quadrant variance of stock 2 and the weightage of stock 2, and here in these two the covariance between stock 1 and stock 2, then we will get this equation sigma p square is equal to this one. Okay, I am not going to read it out. It is understood, otherwise the video becomes too long. So what is the conclusion which we can draw from this equation? We can draw a conclusion that the variance of the portfolio is sum of the weighted variance of individual securities. That is weighted variance of individual securities. What is that? Omega 1 square into sigma 1 square plus omega 2 square plus into sigma 2 square. That is the sum of the weighted variance of individual securities. And the weighted covariance between the two securities, which is that component, that is 2 times omega 1 into omega 2 into sigma 1 into sigma 2 into rho 1 2. That complete component will become weighted covariance between the two securities. Now we can extend this logic to any number of securities. So suppose if we consider a portfolio having n stocks in it, so we can give the variance of the portfolio as sigma summation and summation of omega I omega j into sigma I into sigma j into rho of ij. So this is the variance of the portfolio having n stocks. Okay. Now suppose if there are 3 securities, let us take an example. If there are 3 securities or 3 stocks, then we can calculate the variance of the portfolio as sigma p square is nothing but omega 1 square into sigma 1 square plus omega 2 square into sigma 2 square, omega 3 square into sigma 3 square plus 2 times omega 1 omega 2 into sigma 1 sigma 2 into covariance between 1 and 2. Similarly, 2 times weightage of 3 into weightage of 2 into standard deviation of 3 into standard deviation of 2 into covariance between 3 and 2 plus 2 times weightage of stock 3 and weightage of stock 1 into standard deviation of stock 3 into standard deviation of stock 1 into covariance between stock 3 and 1. So we can keep on extending this logic to any number of security. So if there are n securities, there will be n variance and n into n minus 1 covariance. For example, if we consider 10 stocks in a portfolio, then there will be 10 stocks into 10 variances, that is sigma 1 square to sigma 10 square, and there will be 90 covariances as we have calculated. N into n minus 1 means n is 10 into n minus 1 is 9, so 10 into 9 there will be 90 covariances. So this concept, as we have just understood, we can conclude that the variance of a portfolio is generally influenced by the covariance terms between the individual stocks. So if the covariance terms are largely negative, this will get deducted from the variance of the portfolio. Hence your risk in a portfolio will be less. So if all the covariance terms are negative, then we can get rid of the risk completely in a stock, but you cannot get 100% elimination of the risk because the variance of the individual stocks will always remain. But in real life scenario, what happens? Some of the securities which you have selected in a portfolio, they tend to move together. That means covariances are positive. So diversification beyond a point will not reduce any portfolio risk. So what is the efficient portfolio for optimization? So there will be 3 situations in this case. Let us analyze 3 situations. So when the coefficient of correlation between securities is 1, that is when the securities are positively perfectly correlated. In the second case, when the coefficient of correlation is 0, that is when the securities have no correlation between them, that is the stocks in the portfolios have no correlation between them. And when the coefficient of correlation between securities is -1, it means the securities are negatively correlated. That means if one security or a stock moves up, the other moves down, like that. That is means they are perfectly negatively correlated. So let us analyze this situation. When the coefficient of correlation, that is covariance between two stocks in a portfolio is 1, that is perfectly positively correlated, we can substitute the value of the covariance term as 1. That is, let us take a two security case for simplicity, and when we put the coefficient of correlation or the covariance between two securities 1 and 2 as equal to 1, then what will happen? The variance of the portfolio will be equal to the weightage of the variance of stock 1, weightage of the variance of stock 2, plus the covariance of the two terms, that is the standard deviation into the weightage, gets added to the portfolio variance. So here what is happening, this component of 2 omega 1 omega 2 into sigma 1 sigma 2 gets added, which is nothing but the covariance between security 1 and 2 will get added to the portfolio variance. Hence the portfolio risk increases. Suppose let us consider when the coefficient of correlation between two stocks in the portfolio is 0, that is they are not correlated at all. What happens? In that case, when we substitute the value of, that is covariance between stock 1 and stock 2 as 0, this whole term will get eliminated. So 2 omega 1 omega 2 sigma 1 sigma 2 will become 0, because we are substituting rho 1 2 as 0. So this complete term will become 0. So what happens? Then the portfolio variance will be equal to the weightage of individual variance of stock 1 plus weightage of individual variance of stock 2. So in the second case, the 2 omega 1 omega 2 into sigma 1 sigma 2 components get completely eliminated. Hence the equation of the portfolio risk, that is sigma p square, is nothing but the portfolio risk, that is the variance of the portfolio. It will get reduced to the extent of the covariance between securities. However, variance of each securities or standard deviation of the each security still exist and still add up, and there will be some amount of the portfolio risk involved due to the beta of individual stock 1 and 2. So when the coefficient of correlation between security is -1, that means if the two stocks are perfectly negatively correlated, then what will happen? The variance between covariance between 1 and 2 will become -1. So when we substitute, what will happen? The covariance component in the equation get reduced from the portfolio risk. So what will the simple fact is that here the covariance value gets just reduced, but the portfolio risk of individual stock in the portfolio still exists. In the last case, that is when the stock is perfectly negatively correlated, we can choose the weightage of the two stocks 1 and 2 in such a way that the portfolio risk will get reduced to 0. So we can conclude that when two stocks in a portfolio are negatively correlated, we can choose the proportion of each stock or the weightage of each stock in the portfolio in such a way that the portfolio risk will be completely eliminated to 0. How to do this? Let us see. So let us substitute the value of rho 1 2, that is the covariance between security 1 and 2 as -1. What will happen? This is the perfect equation of the quadratic equation. What is that? A square plus B square minus 2AB. So sigma P square is equal to A square plus B square minus 2AB. So what we can write? We can just write sigma P square is equal to omega 1 into sigma 1 minus omega 2 into sigma 2 whole square. So what will happen if we cut these squares from both sides? We will be left with portfolio standard deviation will be equal to omega 1, that is the standard deviation of stock 1 into its weightage minus standard deviation of stock 2 into its weightage. We know that in a 2 security case, the proportion of the portfolio value will always be 1. That is, omega 1 plus omega 2 will always remain 1. So what we can do? We can find out the value of omega 1 in terms of omega 2 or the weightage of 2 in terms of weightage of 1. So if we consider weightage of 2 in terms of weightage of 1, so weightage of 2 become 1 minus weightage of omega 1. So sigma P will become omega 1 minus sigma 1 minus 1 minus omega 1 into sigma 2. Understood? I am just doing the simplification, substituting omega 2 is equal to 1 minus omega 1. So the standard deviation of the portfolio will be equal to weightage of stock 1 into standard deviation of stock 1 plus standard deviation of stock 2 minus standard deviation of stock 2. So taking this further and simplifying, if the proportion of security 1 as below can be kept to 1, then we can drive the risk of the portfolio to 0. How is that? Let us understand. We know that omega 1 is equal to sigma 2 divided by sigma 1 plus sigma 2. So suppose if sigma 1 is equal to 0.2 and sigma 2 is 0.6, then omega 1 will be 0.75 and omega 2 will become 0.2. That is the weightage of, if the standard deviation of stock 1 is 0.2 and standard deviation of stock 2 is 0.6, then we get these values. So if we substitute these values, what will we get in this equation of the variance of the portfolio? When the covariance between stock 1 and stock 2 is perfectly negatively correlated, that is minus 1, then we get the portfolio standard deviation will be equal to 0. That is, the risk of the portfolio will become 0. It means if we have the weightage of stock 1 with a standard deviation of 0.2 as 0.75 and weightage of stock 2 with a standard deviation of 0.6 as 0.25, that is 25% of weightage for stock 2 and 75% weightage for stock 1, then the portfolio risk will be 0. So let us understand in the context of the practicality. In practical, a person can invest in bonds also and in security also. So how do we get a minimum variance portfolio? That is, minimum variance means minimum risk portfolio. So if we consider weightage of bond as omega B and weightage of equity as omega E and sigma B standard deviation of bond and sigma E standard deviation of equity and rho BE as the coefficient of correlation between equity and bond or covariance between equity and bond, then we can have 1 minus omega B will be nothing but the weightage of equity omega E. So the value of weightage of bond that minimizes the portfolio variance will be omega B minimum is equal to sigma, that is sigma S square minus omega B in sigma B into sigma S into rho BE divided by sigma B square plus sigma E square minus 2 times sigma B into sigma B in sigma E into coefficient of correlation between B and E. This is a simple mathematical concept. I will not explain it. You can just go back to the previous slides, understand that concept, and if you put the same concept here, you will get the same answer which I have given here. Now let us understand what is a feasible frontier when coefficient of correlation is either 0 or 1 or -1. See, this is the graph where the x-axis determines the standard deviation of the portfolio and the y-axis determines the expected return. Now we have two stocks omega 1, stock 1 with weightage of omega 1 and stock 2 with weightage of omega 2. If we make omega 1 is equal to 1, that is, if the portfolio has only stock 1, then if you draw a perpendicular line here, this is going to be the standard deviation of the portfolio, that is the portfolio risk, and this is going to be the return. Similarly, if you take only omega 2, that is stock 2 in the portfolio, ignoring stock 1, 100% portfolio consists only of stock 2, then this will be your sigma p, that is the standard deviation, and this will be your risk, expected return. So with increased risk you have increased expected return. However, if we consider a combination of the stock 1 and stock 2 in the portfolio, then you will get this green line, that is the feasible frontier of, that is, with the various combination of stock 1 and stock 2, you will keep on getting a portfolio A, portfolio B, portfolio C, portfolio D, depending upon your risk taking ability. So when the correlation between the stock is 1, that is, when the two stocks are positively correlated, if you take this black line, when the proportion of the stock 2 keeps on increasing, then your standard deviation keeps on increasing here, and at the same time your expected return will increase. It means if stock A rises 10% and stock B also rises by 10%, here both the stocks will have the same amount of movement in a particular state of the economy. In such case, diversification will not result in any reduction in the risk, because both stock will move in the same direction in the same proportion. So even if you whether you put two stocks, one stock 50%, another stock is 50%, since they are moving with the same percentage of return giving, so you will not get any reduction in the portfolio risk. The portfolio risk keeps on increasing. However, when the coefficient of correlation is -1, it means both stock move in the opposite direction. That is, if one stock in a particular state of the economy, if one stock rises by 10%, another stock will, that is the second one, will reduce by -10%. Hence here the standard deviation decreases, that is the risk decreases, when however the expected return will increase. That's why if you take on this particular line, so the standard deviation decreases, but at the same time the expected return keeps increasing. That is because of negative relationship between the two securities in the portfolio. This we have already understood. With the perfect negative correlation between two stocks in a portfolio, we can drive the portfolio risk to 0. That we have already proved and exhibited with the help of the mathematical equation. However, when the correlation is between -1 and 1, it means both stocks move in different direction. It means if stock A rises by 10%, stock B may rise by 5% or by 0% or -5%. Here we have to choose stocks in such a way to have an optimum portfolio. So at point A, that is the feasible frontier which we are considering, omega 1, omega 2 are negatively correlated, as I have explained on this particular line. Hence, this small negative curve will say that the standard deviation actually reduces when you have a combination of omega 1 and omega 2. That we have to find out using that minimum variance portfolio as I described previously, 0.75 and 0.25 combination with a standard deviation of 0.2 and 0.6. However, at point B, omega 1 and omega 2 are positively correlated. Hence, the proportion of omega 1 and omega 2 varies, the portfolio risk, that is the sigma p or the standard deviation, accordingly increases. At point C, the stock 1 and stock 2 are more further positively correlated. Hence, the standard deviation will increase further. So, this is the feasible frontier, that is this one. 1, A, B, C and here omega 2, this green line will be the feasible frontier for a portfolio having combination of two stocks 1 and 2. Okay. Now, let us analyze what is indifferent curve. Indifferent curve actually it is based on the satisfaction level. See, this curve I2 is a risk averse curve with a lesser slope, and I1 is a risk taker with higher slope. So, however, on each particular curve, like if I am taking I2 curve, the satisfaction level here in the I2 curve is dependent upon the amount of risk the individual is ready to take. So, as you keep on moving from this point to this point, the satisfaction level based on the satisfaction or the risk taking ability, the expected return and the risk keeps on varying. However, between the curve I1 and I2, the risk taking ability is totally different. They are not indifferent. Here on this curve, any point on this curve, the satisfaction level differs. Hence, it is an indifferent curve. It means you can vary the portfolio combination by on your own and depending upon your risk taking ability, and still have an expected return as per your satisfaction. But this is a different satisfaction level. Here he is a risk taker. Here also, if you are a higher risk taker, you can try this. If you are a lower risk taker, you can have a combination of stocks depending upon your choice. Now, let us come to the very important concept of capital asset pricing model. With all the mathematical equation, mathematical analysis which we have done, covariance, coefficient of correlation and minimum variance portfolio, with all this combination, let us analyze and take the capital asset pricing model. See, capital asset pricing model, it tries to understand the relation between risk and return for an efficient portfolio or for an individual stock. But we have to do some assumption when we consider a capital market portfolio. We will do it for a single period horizon. We know that every individual tries to avoid risk and expect the portfolio to perform well or perform optimally in a single period horizon. Expectation of all individuals are the same. They have the same estimate with respect to mean, variance and covariance. These are all the assumptions which we are making in order to derive a capital asset pricing model equation. Here we say that every individual avoid risk and he expect an optimal portfolio, and all individuals in the entire universe have the same estimates with respect to the mean, variance and covariance of stocks and portfolio. It means everybody will say the risk of investing in Reliance is the same. It is not that one person A is saying I expect that the Reliance may give 5% returns. Person B say Reliance may give 7%. No. In the capital asset pricing model assumption, everybody in the India will think that Reliance will give a return of 5%. That's what they are trying to understand. And the standard deviation in the variation of returns in the Reliance is 2%. That means the Reliance return of the Reliance may vary from 3 to 7. That is, since the standard deviation is 7 and the mean, everybody is saying that the average return given by the Reliance is 5% and the deviation is 2. So 5 minus 2 and 5 plus 2 becomes 3 and 7. Here it assumes that individual can borrow and lend freely at riskless rate of return. It means people can borrow money from others without paying any interest, zero interest. This is what is being assumed in the capital asset pricing model. Bank will give you money with zero interest. You don't have to pay any interest. As soon as you go and ask bank 1000 rupees, they will give you. You don't have to pay them interest. You only have to give them back the 1000 rupees. That is called as riskless rate of interest. Here it is considered the market is perfect. If you go to the random walk theory, market is always imperfect. But here in the capital asset pricing model, it is assumed that the market is perfect. That means there is no taxes involved. There will be no transaction cost in your the brokerages. The securities are completely divisible and market is highly competitive, and how much the securities are risky, that is what is the beta of the each security or stock is already given. With these assumptions, we will derive the capital asset pricing model equation. So what are the inputs required for getting a capital asset pricing model? One is the risk-free rate. Risk-free rate means, let us consider that you put 100 rupees in the bank. See, whatever may be the state of the economy, the bank, if it says that it will give you 7% interest, it will give you 7% interest for the entire one complete year or the period under which you have kept the FD for. Suppose if you have kept the FD for 1 year, whatever may be the market variation, you will get 7% rate of interest. That is known as risk-free rate. Here the beta of the fixed deposit is 0. It does not vary. However, if you put the same 100 rupees in the stock market, every day the stock price keeps varying. So the interest rate which you are going to get from the stock market will keep on varying every day. So that is not the case with the FD. That's why beta of the fixed deposit is 0. But how do we know what is the risk-free interest rate? Because every bank gives different interest rate. Every corporate gives fixed deposit different interest rates. So generally it is considered that the stocks or the treasury bills raised by the government, whether it can be US government or American government or British government or any government or the Indian government, long-term treasury bills, having duration of 10 years, 20 years, whatever the interest given by those government's bonds, that is considered as the risk-free rate. In India, you can consider that the government bonds and RBI interest rate as the standard. That is, RBI issues bonds. So whatever is the interest rate set by the RBI bond, you can take it as the risk-free rate. Now next is the market risk premium. So what is the market risk premium? Market risk premium is nothing but the difference between the expected return of a particular stock and the risk-free interest rate. Suppose return given by Reliance in 1 year, Reliance stock in 1 year is 12% and the risk-free interest rate is 7%. So your market risk premium is 5%. So that is the market risk premium. For calculating market risk premium, the historical data of mean return of Reliance or mean return of a stock should be as long as possible, possibly 5 to 10 years. And the average return given by a particular stock for calculating the market risk premium. Basically, we use the arithmetic mean, we do not use the geometric mean. So the market risk premium based on state of the economy, the political stability in the country, and the structure of the market, whether the market is stable, developed country or developing country. Based on these factors, the market risk premium also varies, because based on the state of economy, political risk and structure of the market, the risk-free interest rate varies. Similarly, the returns earned by a stock also varies depending upon the state of the economy, political risk and structure of the market. Now, beta we have discussed n number of times. It is the slope of the regression relation between the return of the market to the return of the stock. Hence, if we want to estimate the period for the calculation of the regression, a 5-year period is considered as an adequate. So we can calculate beta by using fundamental data like the financial leverage, in which industry oblique sector. Financial leverage I have already explained. Industry oblique sector, see, real estate have high beta, auto have high beta, whereas FMCG and pharma have low beta. And what is the corporate growth? In which growth phase, whether the particular company in which you are investing is in induction phase or growth phase or maturity phase, or they're in the downward phase. So you can check out based on that the corporate growth is accordingly changed. And next, earnings visibility. Earnings, every company comes with earnings visibility. We can go and check what is the earnings visibility. So based on that, the beta will also accordingly change. Usually large cap companies or large cap stocks, bigger companies will have less beta, whereas small companies will have high beta. Also, if the market is matured market like US market, nowadays Indian market is also can be considered as a mature market. They will have generally a stable, that is the stocks will have a stable beta. So now let us understand the capital asset pricing model concept. See, any investor, even in India or everywhere in the world, usually if they want to build a portfolio, they build a portfolio with a combination of risk-free interest rate and investment in stocks and securities with high beta. So like if we want to invest in India, first we say, okay, let us invest 20 to 30% in fixed deposit, 10 to 15% in government bonds, and another 55 to 65% in the stocks oblique real estate. So this is known as a combination in a portfolio. This is based on the efficient market hypothesis. Now, if we consider RF as the risk-free interest rate on this expected return y-axis, this is the risk-free interest rate, and we know that this is the efficient frontier for any combination of stocks in a portfolio. And if we draw a straight line tangent to this efficient frontier, then we get at the intersection of this efficient frontier with the straight line from the risk-free interest rate is the efficient portfolio. This here it is, M is the efficient portfolio, because this is the tangent to this efficient frontier curve. However, what happens if everybody, suppose let us assume a portfolio S. This portfolio S has stocks which makes the portfolio efficient. So what happens, everybody knows, everybody is doing the same thing, as we have understood that every person, capital asset pricing model, what is the assumption made? Assumption made is every person knows what is an efficient portfolio, and everybody knows what is the probable rates of return of stocks involved. So if everybody starts buying stocks in portfolio S, the stock price increases. Whenever the stock price increases, the expected return of that, because the price to earnings ratio will increase, as a result what happened, the expected return decreases. However, there are certain stocks which may be good but which may not be in that portfolio S. The expected, the price of those stocks reduce because more people are investing in stocks which is there in portfolio S. As a result, the price of those stocks which is not there in portfolio S decreases even though they are good stocks, and their expected return increases. As soon as the expected return increases, people tend to include those stocks in their portfolio, and hence we will get another portfolio as L. So this here there is a small straight line, we can take it as a tangent to the efficient frontier, where the portfolio keeps varying between M and L. So this shifting of the efficient portfolio this can happen along this tangent or the straight line. So any portfolio which is perfectly positively correlated with market portfolio, naturally market is always efficient, market is always right. As a result, if you have a portfolio which is perfectly aligned with the market returns, then it is considered as the efficient portfolio. So if the covariance between your portfolio and the market portfolio is equal to 1, then your portfolio can be considered as an efficient portfolio. So the risk and return of an efficient portfolio is nothing but the equation of a straight line which we have drawn from the risk-free rate M and L, which are the two portfolios on that tangent. This line which we have drawn is called as the capital market line. So let us understand this with a mathematically. So expected return of a portfolio which we have made will be equal to the risk-free interest rate plus, you can say, lambda into sigma p. So this lambda, you can either call it, you can put lambda as beta also, but for our convenience here we have put it as lambda, which is nothing but the beta of the or slope of that straight line. So, and sigma p, we know standard deviation of the portfolio. So the slope of the capital market line, what is the slope of the capital market line? It is beta. So beta is the slope of the capital market line, which is given by expected return of the portfolio minus the risk-free interest rate divided by the sigma of the portfolio. If we consider the market portfolio, then instead of expected return of a particular portfolio, we will consider market portfolio. So we say expected return of the market minus the risk-free rate divided by the standard deviation of the market portfolio. We are considering two portfolio, one our own portfolio P, and the market portfolio, that is sigma M. So what is beta? Beta you can also say as the price of risk taken in the market. Now what is security market line? See, capital market line gives a linear relationship between expected return and the standard deviation. However, many people may not be having an efficient portfolio, some people may be having an inefficient portfolio. So can we have an equation for that? Can we have a linear relationship between portfolio of the inefficient portfolio and the efficient portfolio or the market portfolio? That can be given by the equation expected return of a portfolio I, which may not be efficient, is given by RF plus expected return of the market minus the risk-free rate divided by the variance of the market into covariance between that inefficient portfolio and the market portfolio. So this equation which we get is known as the security market line. Okay, now sigma M square is variance of the market portfolio, expected return of RM is expected return of market portfolio, and Sigma IM is nothing but the covariance of returns between security and market portfolio. Hence, expected return of any security or any portfolio I is risk-free rate or risk-free return plus price per unit of the risk into the risk which you have taken. This is the price per unit of the risk. That is, expected return of the market minus RF divided by sigma m square is nothing but your price per unit of risk. And sigma IM, that is covariance between an inefficient portfolio I and the market portfolio, is nothing but your beta or the risks which you are taking. Let us come back to the basic equation of the beta, which is covariance between Ri and Rm divided by sigma m square. But if we substitute beta is equal to, we know that beta is nothing but the covariance between inefficient portfolio I and M divided by the variance of the market portfolio, we can substitute this value in instead of beta. So sigma Ri for a security market line equation, sigma Ri, that is expected return Ri, is equal to Rf plus expected return of the market minus Rf into covariance between the stock, the portfolio I and M divided by sigma m square. This is what we are substituting here. So ERI is equal to RF plus expected return of the market minus RF into beta I. This we had in the previous equation. We are actually substituting this component with the beta of the market. So here the expected return of security I is nothing but the risk-free return plus the market risk premium into the beta of the security or the beta of the portfolio, of the inefficient portfolio. Now let us understand what is the relationship between security market line and capital market line. Actually, capital market line is a special case of security market line. So if we consider the security market line equation, where is expected return of an inefficient portfolio is nothing but risk-free rate plus expected return of market minus the risk-free rate divided by variance of the market portfolio into covariance between a portfolio I and the market, then we know that the variance between portfolio I and market is nothing but standard deviation of the portfolio I, standard deviation of the market, and covariance or coefficient of correlation between the portfolio I and portfolio M. So expected return of a portfolio I, which is the security market line where we consider an inefficient portfolio, is equal to RF plus expected return of market minus the risk-free rate divided by sigma M, because we have substituted this here and one sigma M gets cancelled. So we get sigma M into standard deviation of the inefficient portfolio I and the coefficient of correlation between I and M. So, but we know that a capital market line is based on an efficient portfolio. It means the rho IM, that is the coefficient of correlation, should be equal to 1. That is perfect. It should be a perfect correlation with the market. Hence, if we substitute sigma, that is rho IM, as 1, we get the expected return of the portfolio is RF plus ERM minus RF divided by sigma N into sigma I. But what is this equation? This equation is nothing but the equation of the capital market line. So with this we come to the end of the portfolio theory. I would suggest that you go through this portfolio theory again and again if you understand the entire concept of the capital asset pricing model, efficient frontier analysis, and what is the efficient frontier, what is an efficient portfolio, what is the capital asset pricing model, and based on this problems can be easily solved. Thank you very much.